how do you move money to the next generation without the IRS taking a cut? Talk a little bit about the first item is the annual gift exclusion. How should I write the checks to the kids or the grandkids? Do they have to pay taxes? Could I pay the taxes for them? What is the annual gift exclusion? How do you do it the right way? And who should be looking at something like this?
A lot of misconceptions about this area of the tax code because the IRS publishes this number every single year. For 2026, the number that we can give to any individual is $19,000 before we have to do something. We have to file an additional tax return. Now that is, just to be clear, $19,000 per person per beneficiary. So Logan, if you and your wife want to give each of your daughters $19,000, you can give $38,000 to each of your daughters before filing a gift tax return. Let's say you give $100,000 to each daughter. Well, now we do have a filing requirement. What does that mean for us? This pairs back to that estate exemption.
Yeah.
So if you gave $100,000 to each daughter, the first 38 is that gifting exemption. That means we've got $62,000 that comes off of your $15 million wealth transfer exemption. So the key takeaway here should be an additional filing requirement. It might cost you a couple $100 to get a CPA to do it. That shouldn't be a barrier or a restriction to giving to our children. So the example in some of the notes we were looking at ahead of time, if you have 3 children and 5 grandchildren, that's about $300,000 for a married couple that we can shift down to the next generation without ever filing a gift tax return, without ever impacting that exemption. We're talking a significant amount of wealth transfer happening annually.
Yeah, and for most folks, that, assuming they have the heirs and those folks, it's really quite feasible without having to really worry about running up on that $30 million today.
Absolutely.
We often talk about, well, the kids are 30 or 40 now, they're in their family, they're raising their kids, or maybe we want the grandkids to go to private school, or we want the pay for the grandkids college or whatever it may be. And it's like, make the impact now if you can. But Corey, how do you know if you can do it without a financial plan?
Yeah, I mean, that's kind of the precipice for all of this, Logan, is having a solid understanding, having the correct team of people around you. I joke with my team frequently. I've got a nice office here at our Lenexa spot here. I spend very few hours in my office because I'm sitting alongside of you or other advisors and making sure that communication's happening with the advisors, with the clients, with the estate team, all sitting in the same room together.
Yeah. One thing before we move on to the next strategy, which we're going to talk about step up in basis. One thing too is, what we're talking about at a high level today is just writing a check. We're going to write a check to daughter 1, daughter 2. One thing that we often talk to clients about that may be in these higher tax rates is, depending on how the kids or grandkids are doing, maybe they're, just out of college, or, maybe they have a little bit of income or very little income, is actually, let's talk about if I bought at $10 a share, okay? And I'm making this up, it's $200 a share right now. What could I do potentially to my grandkids that maybe just are starting out working and actually pay 0% capital gains? Because remember, we're talking about how do we transfer wealth to the next generation on today's show.
Yeah, so remember, everything that we're talking about today is capital gains, right?
Yeah.
We're not talking about a transfer from our IRA. We can't really
talk about that in a little bit
effectively. But if we have capital gain type transaction that you're talking about here, we could actually gift the shares in kind to the grandchildren. They're at a very low tax rate. They aren't working a whole lot yet. Got to be careful about some kiddie tax issues.
Yeah.
But if we've avoided some of those areas, they can potentially liquidate that stock at a 0% federal capital gain rate. Now we're talking about solving one of the problems we might have in the existing accounts for our clients while shifting that asset down to the next generation very tax efficiently.
Yeah, let's think about, and the whole premise of this potentially being that we transfer it, they sell the asset at 0% capital gains, and they have the cash proceeds to pay for whatever, college, cars, homes, whatever we want to do there. Let's talk about one of our favorite strategies we talk to clients about is the step up in basis philosophy. So I'll let you explain it, but let's take the same example. I bought $10 a share. It's worth $200 a share. my wife and I, or whoever we decide, clients decide, hey, look, it's been great to us. We're just going to hold it until forever. And the girls will worry about it one day. That's what we hear a lot of, like, hey, look, I'm not going to be here. Someone else is going to worry about it, which, by the way, that's not the best wealth transfer strategy that we've seen. But what does step up in basis mean in this example?
Yeah, so this applies again to our non-qualified, taxable, whatever word you want to use there, type accounts. Also applies to real estate. It applies to a business we might own. So a lot of different assets would qualify for this step up in basis. And to use your example, we bought at $10 a share. It's now worth $200. We pass away. Grandchildren inherit this stock. Their basis shifts up to the fair market value on the date of passing. It's worth $200. Their basis now becomes $200. Meaning they can liquidate the full stock at zero capital gains.
So, Corey, it's really something to think about of asset location, one way to think about it, but two, your income planning. And this is where you do such a critical job. Not so much thinking about the wealth transfer piece, that's a part of it. But when we think about a couple coming to us at 50, 55, 60 years old, how do we deliver income in a tax efficient way for 30 or 40 years? This becomes a big piece of the puzzle because we may have an ACA or a healthcare gap that we want to keep income low, but when we get to 65, 68, maybe we don't really have that many IRMA considerations with the IRA. Maybe we want to do some QCDs, which we can talk about. I probably don't want to touch this money if I like the stock that I have under current ruling.
Yeah, absolutely. I mean, we've had some recent cases of this where the Roth conversion didn't make a ton of sense. It's a fairly high tax rate, charitably inclined. Let's give that money to charity and pay no tax on it. Two big barriers is the dividends, interest,
sure,
capital gains if we sell are taxable during our lifetime. And the second there is we don't get the 10 years of tax-free growth that we could inside of a Roth IRA. But it's a good solve for the right fit.
Yeah, I mean, because a lot of times too, people that we'll say high net worth, this $2 to $10 million demographic we're speaking really to today, they started saving and using a brokerage account before a lot of times they even started working with a financial advisor. A lot of times I'll say inherit these type of, which are good problems to have, but then it's our job of working as a team with the estate planning team, with the tax team, with the advisors to say, how do we actually maximize this wealth transfer or how do we leverage this asset, which you just alluded to it. Roth conversions as estate planning is this third strategy that we're going to talk about. So talk to me a little bit about this because I think that Roth conversions are great for a lot of people. Roth conversions may also not be great for some people because Corey, ultimately, hey, look, I'm going to do a $200,000 Roth conversion. Maybe my effective tax rate to do these is 30%. Well, I just lost wealth that I could transfer to the next generation. The third piece of this, before I let you kind of talk a little bit about it, is when we transfer an IRA to the next generation, they have 10 years to take out the balance, okay? Corey, one of the things we often talk to clients about, and we get this weird stare sometimes, is, well, how well are your kids or grandkids doing? And if one of your children maybe is a high earner, maybe the other one isn't a high earner, do we think about how we transfer this wealth to them? Or, I'll say the Holstein family estate pays the least amount of taxes, right? The kids and grandkids keep their, as much wealth as they can. But why do Roth conversions make sense for estate planning and why don't they make sense for estate planning?
Yeah, so I think you were hitting the nail on the head there is we have to understand what is the family estate? How are the beneficiaries doing financially? Because that is a big driver. We have to overcome a 30% hurdle in this example. Well, the counterpoint there is we have 10 years for the beneficiaries to distribute that IRA money. The IRA beneficiaries may not have the ability to give that money directly to charity like the parents have. And at this stage, it's pretty easy to get to this 22% tax bracket as an IRA beneficiary. So that it becomes understanding the different components there of how the family dynamics are working, those types of considerations. Where might a Roth conversion not make sense? Maybe we're very charitably inclined. Maybe some of that asset actually is being designated to charity at the end. We don't want to move that money to Roth and now send Roth money to a charity. That's a 30% haircut for that organization or for the family estate. The other thing is we'd want to think through just different, again, family dynamics with all of this. Understanding that, hey, maybe we do shift some of that Roth money to some of the higher income earners of the family, and we kind of discount the IRA portion for some of the lower earning individuals of the family. There's a lot of different ways you can look at that.
Perfect example, and now we're not going to get into this today, but we always talk about with estate planning, you could sometimes be tax efficient or you can exercise a lot of control, which we're not going to talk about. But ultimately, a strategy that sometimes makes a lot of sense is, hey, the kids are, in their 50s, they're in their peak earning years. We got these grandkids that we do trust to leave some money outright to. They're just starting out, or they're, in their family formation years. And maybe they are in the 12% tax bracket. So it does make some sense. But Corey, everything we just talked about, these are all powerful tools. But that doesn't mean it's the right tool for you. And once again, you cannot talk to a professional, a CPA, financial advisor, unless you really define what it is that you want to have happen in your life. How do you want the wealth to transfer? Because none of this stuff matters if your money's all in an IRA and you say, hey, look, I don't want to give it to the kids. I don't want to give it to the grandkids. I'm going to leave it to these three causes. Well, why would we never do a Roth conversion, Corey?
Because the charity's never going to pay tax on the IRA anyway.
So one of the things that's critical is you're sitting down with your spouse, if you have a spouse, and making sure everyone's on the same page of how you want money to be passed to the next generation. So
the views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.